So now let's talk about what are the various fields under corporate law. As I had explained that corporate law can be broadly categorized into two broad heads, from a legal point of view and from an industry point of view. Now from a legal point of view, as I explained that we have got mainly 4 or 5 broad headings. Let's talk about each one of them a little bit in detail. M&A, we call as mergers and acquisitions. Now when we say mergers and acquisitions, for a law student it may appear that this is something to do about amalgamations and restructuring, which happens through a court-driven process, which is basically, earlier it was High Court and now it's NCLT. But that is not what we understand from an M&A when we talk about M&A from a corporate law point of view. So from an M&A, what happens? And M&A and joint ventures are basically a part of same practice areas. So M&A from a corporate law point of view means that when one company is acquiring shares in another company. Now the acquisition of shares by one company in another company can be either through a primary issuance or can be through a secondary purchase. What I mean to say is that the company can either get fresh shares subscribed or can purchase it from the existing promoters of the company. Now why do they do that? They do that to form a strategic alliance. Now there is a company A, I will not take names of the companies. Now there is a company A which is working in a field of, say for example, manufacturing automobiles. And there is a company B which is in the ancillary industry. It is manufacturing some raw materials for the automobile industry. Now company A, in order to have a strategic value for its own business, would want to acquire shares of company B so that it can take some value. Now it is going to be beneficial for both the companies. In this case, what company A will do is that they will, based upon pure commercial negotiations and discussions between the parties, company A will acquire shares in company B. Now, how many shares are they going to acquire? Maybe 10%, maybe 15%, maybe 25%, maybe 49%. Till the time they acquire less than 51% or less than 50%. Typically, we say that they have acquired minority stake. When they acquire more than 51%, we say that they have acquired majority stake. And if it acquires more than 75% stake, it literally becomes the whole owner of the new company and it has a substantial stake now. Now, when this happens, there is a process involved. It is not written in law, but there is a process involved. Now, when company A has to acquire shares in company B, company A will initially do a due diligence. It will understand the entire company in detail. There will be a legal due diligence, there will be a financial due diligence, and depending upon the industry of the company, there can also be an environmental due diligence. Once the diligence takes place, which is a process of nearly about say 15 days to a month, company A will be in a position to know as to what exactly is the size of the company B, what are the risks, what are the potential liabilities, and what kind of assets company B has and what kind of value they are going to determine. Based upon that, they will determine the price per share, in the sense that how much money company A has to invest or pay to the shareholders of company B to purchase certain shares. Once the diligence is complete, then parties enter into a negotiation of documents. Now, if it is going to be an acquisition of shares, then they will do a share purchase. If it is going to be subscription, they will do a share subscription agreement. Till the time company A does not acquire 100% capital of company B, there will also be a shareholders agreement. And why? Because the shareholders of company B are still holding some shares in company B. Now company A also holds certain shares. So there has to be shareholder agreement which will determine who will control the board, who will control the business of the company. If company A or company B, either of them, whichever is in minority position, how will their rights be protected? Then there are various commercial rights with respect to transfer of shares. They may also have some kind of an exit options available. So all of this forms part of mergers and acquisition practice. So this is a very broad description. Obviously, it is not possible to give a very detailed insight over a video. But this is a broad description as to what happens in M&A. So it has nothing to do with court. Nobody goes to the court. Similarly, when we talk about private equity. Now, private equity, as the name suggests, it is a means to raise financing for the company. Now, say for example, there's a company A. Now company A is in requirement of certain money. Now for some reason, it can be either based upon tax or it can be on a commercial reason, it does not want to take debt. It does not want to take loan from a bank. So then it will go for private funding. Now when we say private funding, it means that it is going to issue shares and invite some private people, which are basically financial investors, to invest money in the company. Now when they invest money in the company, the process is more or less the same, the initial process which I explained in M&A. The private equity investor will also do a due diligence in the company. Based upon the due diligence, he will determine the risk areas and he will enter into a negotiation with the promoters of the company. And then again there will be the same set of documents, which is share subscription agreement, share purchase agreement, and there will be shareholders agreement. Because private equity investor will never take a 100% stake in the company. Never means in most of the cases. Now the fundamental difference between a private equity investment and an M&A is that when we say M&A, it is more of a strategic in nature. There are two companies working in the same field or in ancillary fields, related fields, and they have joined hands to do some business together. Private equity investor is a pure financial investor. He will not interfere in the business of the company. Private equity investor will only take rights to protect their investment. They may take some affirmative rights, they may take certain minority protection rights in order to protect their investment. They will not interfere in the business of the company. And the most important distinction with respect to M&A is that private equity investor is not going to stay with the company forever or for a longer time. Typically, it is an exit term of 3 to 5 years. After 3 years or 5 years, whatever they have agreed, the private equity investor would want to take his money back based upon certain pre-committed IRRs, which we call as returns. IRR is internal rate of return. They would want to, so for example, in a very simple mathematical number, if they have invested 100 rupees, they would want to take out 120 rupees back after the end of 3 years or 5 years. Now, in order to do that, they will take certain rights to ensure that the promoter runs the business in a manner which is able to give them the returns back, which typically would mean that they will not allow the promoter to take the money out. The entire money is invested in the company, and company will not declare dividends, and company will not give any kind of money payout to the promoters till the time private equity investors are paid out. So this again has nothing to do with the court, and this is a very common and a very substantial area of practice for most of the corporate law firms in India. Now, M&A, joint venture, private equity are more or less to do with equity capital of the company. Now, let's talk about project finance. Now, when we say about project finance, the word finance does not mean the equity funding. Project finance means companies which are in infrastructure projects. When they require debt, when they require financing, they go to the banks, and when they take debt from the bank, the lenders will always create a security and will create a charge on the assets of the company. And this entire process and the documentation is what we call as project finance. Now, what actually happens in project finance? Now, again, let's take an example. This is company A, which has got a contract to build, say for example, a national highway. Now, when we talk about the building and the building cost, it's in crores. It's not like 10 crore, 15 crore. It is in like 1,000 crores, 2,000 crores, 5,000 crores. Now, it is not possible for any promoter to put entire cost in the company. Even if it is, nobody would want to put. Typically, they work on a 70 to 30 debt equity ratio, which means that if the project cost of a particular project is, say for example, 1,000 crores, out of that 300 crores will be invested by the promoter as equity, and for 700 crores, they will go to the bank and take funding. Now, bank when gives funding, it will not give in the form of equity shares. It will give a loan, which has to be repaid in a certain time period, which can be say 15 years, 20 years. Now, this is called project financing, which means financing by the bank. Now, again, when the financing has to take place, initially the banks will always give a sanction letter, which will have the principal terms on which the loan has been given. For example, there will be at what rate of interest, what is the tenor of the loan, what kind of security is being created, what is the amount of installments, and such conditions. Once the sanction letter is agreed, then bankers will do a due diligence on the project company and on the infrastructure project. Once they have got a comfort on that, then they will start entering into documents. Now in a project finance, typically there are various documents. Unlike a private equity or an M&A which has only got 2 or 3 set of documents, it has got security documents, it has got lending documents, it has got an escrow arrangement, it has got a security arrangement. If there are more than one banker, there will also be a security trustee agreement and a consortium agreement between the bankers, but still there will be an agreement. Now, when the banks give the money, on the same day, they would want to take a security and they would want to create a charge on the assets of the company. Now, those assets can be would be immovable and movable, and even the future incomes is under charge. Now, all of this comes under the security documents. So, this is basically what happens in a project finance. Now, let's talk about capital markets. Now, in capital market, as the name suggests, most of you would have heard stock exchange, right? BSE and NSE trading of shares. So when we talk about capital markets, always think that there is something to do with the stock markets. So when we talk about capital market practice, from a very, very broad point of view, there is an IPO, there is a QIP, and to some extent there is SEBI takeover code involved. Now what happens in these? When a company which has been there for a substantial period of time, has been running its operation and now wants to raise more equity, which is not possible for a single investor to invest, then they go for public funding. When they go for public funding, they will invite public to subscribe to their shares. When they do it for the first time, that is called IPO, initial public offering. When they do it consequently, there will be further public offerings. There is also under the SEBI ICDR regulations kind of a specific category called QIP, Qualified Institutional Placements, which is that you raise money not basically from general public but from qualified institutional investors. Now, what happens in this? As a general public, they will come to know about the offering only when the company publishes its DRHP. But the work starts much before that. And SEBI, which is Stock Exchange and Board of India, is the authority which manages all the rules and regulations of this. Now, the entire process has to be managed by what we call as BRLMs, which is Book Running Lead Managers. So, they are basically the bankers who have to ensure that the entire process is as per rules and regulations of SEBI. Now, initially when the BRLMs are appointed by the board of directors of the company to raise certain funds, BRLMs will appoint certain lawyers, law firms to do a diligence on the company. They will do a diligence. After the diligence is done, they will prepare what we call as DRHP, which is Draft Red Herring Prospectus. Now, as the name suggests, red herring, it means that it has to be identified what are the risk areas. The laws by SEBI is very clear in this regard, is that when the company is going public, it has to inform the public at large as to what are the negative things, what are the risk areas, and there cannot be any kind of a caveating. It has to inform that if you put the money, these are the risk areas. For example, if the company has got, say for example, 10 litigations, out of which there are some 3 or 4 critical litigations involving tax and all those. So they have to inform the public that if you put the money and if you invest, there might be a possibility that tomorrow the share price might go down because we have got certain tax litigations against us and the tax authorities may seize our assets or may seize our bank accounts. So everything has to be disclosed. Now, so this entire thing happens through by way of a diligence. Once the diligence is complete, people start working on what we call as a DRHP, Draft Red Herring Prospectus. Once DRHP is filed, then that becomes an RHP, which is called Red Herring Prospectus with the SEBI. SEBI will give their comment. Now, this entire process of raising, so there is no agreement with the other side. There is no documentation. There is no contractual agreement as is in the case of a project finance or an M&A or a private equity. This is just a DRHP which you file, and this entire process is called capital markets, which I just talked about IPO. Then there is takeover code also involved, which is one of the practice areas under the capital markets, which is that a company which is already listed, if any shareholder who is acquiring substantial stake in the company Like the recent example, what you guys must read about what has been happening in L&T, acquiring Mindtree, because it has already acquired certain shares from the promoter from one of the promoters of Mindtree. So when any company, when any entity, whether an individual or a company, acquires substantial stake in an already listed company, it has to give an offer to the public to acquire shares from public as well. So this is called takeover code. It's a very, very broad perspective. The idea is just to explain that what actually corporate law is all about, because these are the things which are not exactly explained in detail in law colleges. So most of the time students don't understand what corporate law is all about. So these were some, and then there are, so you can have more field, like you can have banking and insurance. It basically deals about that when the company is in requirement of a day-to-day funding, they will go for fund-based facilities and non-fund-based facilities. So basically, when you raise debt on a day-to-day basis, so that's basically banking and insurance. Like insurance is when company has to get all of its mega assets insured. What are the kind of insurance laws and what are the various policies and what are the contractual arrangements with various insurance companies. Then there can be IP, intellectual property. Intellectual property is a different field in itself, which is again has nothing to do with the courts. When you go for an IP trademark infringement, yes, then you go to the court. But there are law firms who practice non-litigation side in IP area, which is filing for patents, trademarks, advising the corporates on what kind of brand names they should go for, and those kind of things, and how do they protect it. So there can be various, but these are the broad areas which a student should know as to what happens in corporate laws.